Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Axis Bank results. I'm really sorry, Ron and Utkarsh, to intervene. Axis Bank numbers, which we've been awaiting for the past 3 hours. The NPA number is fairly modest at 6.8%, 6.77 to be precise. It's much lower than what analysts were expecting. People were prepared for, even up to 8%. So that is the first relief that is there in the Axis Bank numbers.
And reported a net loss of 2,189 crores. So that compares to our poll of profit of about 140 odd crores. So a net loss over there owing to higher provisions.
The poll was always wrong because Axis Bank did not pay advance tax. So it was always expected that in the fourth quarter they would not be reporting a profit. This extraordinary net loss that they have announced is because of a very high provisioning number that you can see. Provisions are 7,180 crore compared to 2,800 crore in the previous quarter. So 3 times more provisioning. It appears that the bank has perhaps taken as doubtful, if not as actual NPA, a whole lot of the loans under their watch list. And although they've reported a smaller gross NPA and not a very big rise in net NPA either, that is because they've aggressively provided about 7,000 crores. But we'll really have to see how much is the loan growth. I think the loan growth will be fairly modest.
About 17.9%.
Okay.
So the total loan book is at around 4.4 lakh crore. So that is a growth of 17.9% on a YOY basis, while on a sequential basis, the loan growth is at 4.5%. But the deposits have outpaced the loan growth on a sequential basis. So while overall deposits on a YOY basis has grown by 9.3%, the sequential growth in deposits is at 10.9%.
Okay, well, I think we also want the provision coverage ratio. My sense is that that would be a fairly decent number going by the aggressive provisions.
Slippages for the quarter is at 16,536 crores. So that compares to about 4,400 crore in the previous quarter. So from this 16,536 crores, 13,938 crore has come from corporate lending. So they have made an accelerated NPA recognition towards the BB and lower book, particularly which forms a part of the power sector.
No, actually, they have a lot of power loans. All the GMR, GVK loans are all with them. And therefore, one would have expected that they would have a lot of these loans. If I remember right, we spoke with Krishnan of SBI Caps, and he was saying that about 18,000 crore of stressed loans was what he was expecting. 16,500 crore of that has been recognized as slipped. So this is well within what analysts in the street were expecting. And therefore, this should not really come as a shock. It may come as a pleasant surprise if the management guides that they have recognized all that they possibly thought is stressed. Actually, Krishnan is with us. Krishnan, we are coming back to you in a minute. Maybe you want to open your own, cell phone and check out the headlines. Mainly, as my colleague Abhishek just read out, it's a loss of about 2,100 crore because of an aggressive provisioning of 7,179 crore compared to 2,200 odd crore provisioning in the previous quarter. Slippages, as he just pointed out, is 16,500 crores, and the bank's gross GNPA now stands at 6.77 compared to about 5.28 in the previous quarter. Net NPA at 3.4 compared to 2.5 in the previous quarter. Most of the corporate slippages, 90%, have come from the BB and below BB book. Now the BB and below portfolio has been reduced by 44% in Q4. Now it is 1.8% of total customer assets. At its peak, it was 7.3%. The watch list has declined by 92% in the fourth quarter and now stands at as of end of fourth quarter, stood at 428 crore. Remember, it was 6,000 odd crore and it stands at 428 crore. So the provision coverage ratio stands at a healthy 65%. Your thoughts on this only, Abhishek? Watch list now down to 428 crore and below BB book now cut to 1.8% of total assets.
Well, Lata, the numbers that you read out, which they gave in the presentation, are all funded part of the balance sheet. We don't know the non-funded part of the balance sheet and how much that has reduced. So as you speak, you know, the watch list has reduced to 400 odd crores. That has come down from 5,309 crore. That is the comparable number, because that is the part of funded. The non-funded was about 700-800 crores. So how that has moved, we don't know. And even in the BB rated book, what they have mentioned, we don't know whether it is part of funded and non-funded together or only funded.
But only 700 crore was non-funded. Okay, then it's not a seriously big amount.
That is for watch list. Okay. But in the BB and lower rated book, 5,000 crore is the non-funded portfolio. So we have to see how that matches up.
Fair enough. Current and savings account on a cumulative basis grew by 18%. Retail fee has grown for FY18 by 22%. That's about the important elements that have come on the core performance of the bank, especially on asset quality. So core operating profit has come in at decline by 12% in Q4. Net loss stood at 2,189 crore. And for the full year, net profit now stands at a profit of 276 crores. Krishnan, that's a fill of numbers that we have given you. Would you also want to know the net interest income number for Q4? It stands at 4,730 crores, and the net interest margin for the fourth quarter stands at 3.3%. First thoughts, Krishnan?
Right. So, as you mentioned, to the extent that the 16,000 crore seems to be a very high elevated, delinquency for the quarter. I mean, we would only look for whether the pool, continues to grow. As long as that pool remains between 18,000 and 20,000 crores, we wouldn't be too worried.
Now, what do you want to be at 18 to 20,000 crore?
So, I mean, we had a sub-investment grade book plus non-fund based exposure. I'm just so I sense that portfolio that was completely at risk there was about 18 to 20,000 crores.
Okay.
And we expected that to dissolve between March and September quarters. So if all of that is being, recognized in one go, at least to the extent that there is no incremental addition to the stress pool, right? You're not adding more and more bad news there.
Got it.
So then I think it's still something that you can work with, yeah.
So that is what you will ask them if you get them at the analyst conference, whether they have added to the BB book, BB and below book?
Yeah, and what other kind of stress they may have added. They may probably have classified something at BBB and now probably downgraded it further. So yeah, so that pool is what we are looking at here.
Okay. Per se, looking at the numbers and the aggressive provisioning and the PCR of 65%, what are your first thoughts in terms of the stock?
So as I said, that variable will be an extremely crucial one, Lata.
What the bank says.
Get a constructive answer to that, a response to that. I believe that a lot of the pain will then be behind. It will be like, in one quarter, in one single shot, you have probably recognized 95% of your problem. There could be some residual stress there. Okay. But if you have continued to add to the problem, then you would have something to worry about.
Okay. Meanwhile, other income has contracted in the fourth quarter by 7%. The other income is 2,789 crore. Previously, in the same period last year, they had done 3,013 crore. I think this was par for the course because trading profit would have been nothing much to say. So fees, trading profit plus miscellaneous income together has contracted by 7% to 2,789 crore. Sorry, Abhishek?
Lata, as you were speaking about the funded part of the vulnerable book or the book which is under stress, that is actually only the funded part. Remember, I'm not speaking the actual total quantum because I don't have the non-funded part of the balance sheet. So the funded part of the balance sheet has declined. The vulnerable stress which can turn into NPA, that book has declined from 15,926 crore to about 9,106 crore. So there's a decline of about 6,800 odd crores in that vulnerable portfolio. So out of the 16,500 odd crore of slippages, maybe around 6,800 crore is from the funded part of the balance sheet which is under stress.
Yeah, and actually another positive or one positive, current and savings deposits as of end of the period Q4 grew by 14% YOY. And remember, it's a strong base. Year ago was the demo quarter, or at least post-demo quarter. and it now constitutes 54% of the total deposits. That's fairly significant. Current and savings account constitute 54% of the total deposits. Savings account and current account deposits on an end period basis grew 18%. Savings account grew 18% and current account 10% for the period ended March 31st, 2018. So it's a fairly impressive growth. The share of current and savings account and retail term deposits in the total deposits stood at 84%. So they're not really dependent on certificates of deposits and wholesale loans. Total deposits have grown by 9%. Okay, we also have Sri Shankar and Siddharth Purohit with us. Sri Shankar, your thoughts? Now I think you've heard it all.
Yeah, obviously the slippages have been much higher than expected. But one good point to me is when we were looking at the standard restructure at the end of the last quarter was 3,495 crores. RBI dispensation was some 6,990. They had SRs outstanding of around 3,000 crores. And the watch list was 16,120 crores. Now, if I take a total stressed asset, if I total up all these things, it worked out to something like 26,000 crores. SR 3,000 crores obviously means that is NPA sold. So if you remove that, it was somewhere around 23,000 crores, excluding the NPAs. Now, if you recognize 16,000 crores out of it as NPAs, I think you have addressed it straight away, so which is a big positive.
Okay.
To me, in fact, when we looked at it, two banks, especially Axis and ICICI Bank, has significant amount of this trust asset, which probably post the 12th February notification from RBI could get classified into NPA. So we have already seen that large amount, which has seen 16,000 crores. To my mind, would be a part of this which will be coming. Okay. Now, when you have this large number coming in as NPAs this quarter, then reversal of interest happens.
Yes.
So it goes and hits your NII.
Income, yeah.
Oh, yeah. So it explains what the income. No?
Yes.
To me, addressing these things, we were worried that it will probably happen in FY19. It has happened upfront.
Yep.
That's a big positive.
Yes, and after all this recognition, their capital adequacy ratio, Tier 1, is 16.57%. The capital adequacy ratio is at 16.57 and Tier 1 is at 13.04. So there is still capital left for growth if they were to pursue it. It's important, for public sector banks, capital even at 8% and 7.5% is adequate because there is sovereign guarantee. Here, the bank has to be adequately capitalized. So they've first found capital from Bain Capital, and after having fortified themselves, they have recognized this, obviously with a big push from the regulator. Siddharth Purohit is also with us. Siddharth, your thoughts on these numbers?
Yeah, Lata, if you look at the numbers, then a large part of the recognition seems to have come from the low-rated corporates and also from the restructured book. So, I mean, I believe that, what even we were expecting that, maybe, the recognition could extend up to FY19. So they have done it largely during this quarter. And if you look at the total slippages, roughly 12,000 crore straightway comes from restructured and the low-rated corporates itself. So only point is that, how that, that low-rated, that BB plus minus these accounts, whether it gets added or not, how dynamic is that is more important. If there is no addition further into that list, then probably large part of the trouble seems getting over for this quarter. And probably in a couple of quarters' time, most of the problem will get over for the bank, I believe. Okay. And as you rightly said, they already have raised capital, and growth has not been a concern earlier also. And if you look at this quarter also, the loan growth has been fairly decent. So I believe now much better days, I would say.
Okay. Yeah, that's Shikha Sharma and Srinivasan Vardarajan and Jairam Sridharan. And I guess Rajiv Anand, yes. All of them are at the Axis Bank press conference. I don't think it's fair to ask you all for a price. Maybe we should hear out what the management has to say. It's a loss for the year, and that's Shikha Sharma.
I'd like to introduce my colleagues, Srinivasan. Deputy Managing Director, I'm sure all of you know him. Rajiv Anand, Executive Director, Head of Retail Banking, and Jairam, Group Executive and CFO. Some of you have seen the numbers already, and I just want to say this quarter has been in many ways different, and there are a couple of areas that I thought I would touch upon before we get into the results in particular. The first is the evolution of the bank over the last 9 years, the bank's performance in this quarter, and our strategy and focus for the coming years. Those are the 3 areas that I wanted to touch upon. As you know, Axis Bank has been one of the top deposit franchises in the country, and for the last 9 years we have continued to build on this strength, growing our market share in deposits from 2.9% in FY9 to 3.7% as of December end. We don't have the market share numbers for this quarter yet, but we hope that that trajectory would continue. We continue to invest in this franchise. We now have close to 3,700 branches, and on the lending side we've grown our lending book to approximately 4.5 lakh crores, giving us a compound growth rate of 21% over the last 9 years. Importantly, on the lending side, we've significantly altered the composition of our lending book. Some of you might remember, our heritage was that of a leading corporate lender in the private sector, specializing in project finance and term lending. Over the last 9 years, we have materially shifted the business mix and diversified our business model. We now have retail loans at 46%, which used to be 20% 9 years ago. We've, during this period, built a very strong credit cards business, which has come from 11th to the number 4 franchise in the country. We've also built organically one of the best wealth management franchises in the country, our Burgundy proposition, which continues to be one of our fastest growing business lines. We're particularly pleased about our digital capabilities. On mobile banking, we are regularly rated as one of the top providers in terms of syndicated customer research, and in terms of actual mobile transactions, we've been amongst the top 3 banks now for months in a row, as per the RBI published data. This year as well, we've continued to see that very healthy growth in deposits, in the cards business, and in the consumer lending franchise through the year. Our SME business has also picked up growth smartly during the last year. Finally, we've also established some very valuable subsidiaries, and I think some of them are now becoming materially relevant for the group as a whole. But one area which I'm sure all of you want to hear about, and which has been an area of disappointment for us, has been on credit risk. We made some significant bets on the infrastructure sector given our heritage, and that's not turned out well for us in this credit cycle, as you know. Our NPA ratios have risen materially over the last 2 years, even though we have been course correcting in terms of the proportion of the corporate lending business. Since as early as 2013, we've been shifting our business mix away from project finance and more towards the higher rated companies and towards more working capital business. We've been lending to flow-based businesses. This journey continues, and the proportion of higher rated businesses has been increasing every single year, and now it's well over 80% that is lent to A and above rated companies. So all of that has been an attempt to improve and focus on improving credit quality. However, for the asset quality pain to really moderate, it's critical that we complete the NPA recognition process. And you ask this question to us every time, and we've not been able to give you a definitive answer. But clearly, what you will see in the results today is that we do think that we're now nearing the end of the recognition process, and we should really start to focus on the resolution process going forwards from here. As far as the financial results for this quarter are concerned, they are clearly a reflection of our desire to accelerate this NPA recognition, get past the asset quality issues as soon as possible. And the recent regulatory framework on resolution of stressed assets is an important milestone in the evolution of credit practices in our country, and it allows this acceleration to happen. It withdraws a variety of restructuring dispensations in existence prior to the guideline, and this obviously I think will materially change credit culture, and for the long term, even though it means short-term pain, I think for the long term it brings a much healthier credit culture and an ability to grow the corporate book more confidently. And I think it becomes effective given that we now have a functioning bankruptcy law. So with a functioning bankruptcy law, it's important to accelerate recognition and move it to resolution. So during this quarter, we've taken, we believe, a very conservative view of the recent regulatory changes and executed all the necessary NPA recognitions. You will hear more about that in detail from Jairam in a few minutes. With this recognition, as I said, we believe that the recognition cycle is more or less over, and we should shift really into the resolution cycle going forward. As far as the capital position is concerned, we raised capital from a couple of marquee investors last year. Given our capital consumption history and the advanced levels of NPA recognition, we believe that we continue to have a healthy capital position. We have some portion of the capital which will come through the warrants next year, and with that we believe we have the ability to continue to grow at high teens to 20% growth for the next couple of years without having to come back to the market for capital. So we're happy with our capital position as it stands today. The last point that I wanted to focus on was the bank strategy for this financial year. As you know, earlier this month, I requested the board that I'd like to move on after December of 2018, and this has been accepted. So you will see a leadership transition. Axis is a great institution, I think, one of the best in the country, and it has a promising future given the capabilities that we have built. And I'm confident that the board will find the right person to lead this institution in its next phase. It should be an exciting opportunity for any leader. While the bank goes through that process, I'm personally fully committed to make sure that the bank continues to maintain high performance levels during this year, and that we continue focused on our execution strategy, which we have uploaded on the website. So you'll probably see it by the evening. The 4 pillars of the strategy for FY19 are: number 1, normalized credit cost; 2, deliver profitable growth in our various lines of businesses; 3, continue to enhance capabilities; and 4, invest in the future. So I'm just going to take a couple of sentences on each of these. Our top delivery for this year is clearly normalization of credit risk. As I said, the accelerated recognition cycle, the high levels of provision coverage should help us to get there quickly. Secondly, as we look at the economic landscape today, we feel increasingly confident about growth opportunities. The consumer side has continued to do well for several years, but with the pickup, early stages, but the pickup in the investment climate, more importantly the IBC-based resolution process, which is resulting in consolidation of loans, I think we continue to see demand on the corporate side as well. And therefore, we see enough growth opportunity in the SME side as well, where formalization of data gives us opportunity to lend to clients we may not have been able to lend to in the past. And we certainly believe our capital position allows us to participate in this growth. What's most paramount for us, of course, is that we continue to earn the trust of our customers, and we continue to serve our customers across multiple channels by investing both in online and branch banking capabilities. And we're delighted that customers have continued to put faith in us, and that is how we've been able to continuously increase market share in a host of retail businesses. This is going to continue to be a significant vector for us in FY19 as well. The third vector is enhancing capabilities, in particular 2 areas that we want to focus on, given the changing environment, given the tighter regulatory scrutiny, given just that we live in a much more demanding environment, is to focus on even stronger operational risk management capability. And secondly, I think we've made lots of changes to our corporate banking strategy. We are looking at how do we get more talent to make sure that this pivoting of the corporate bank strategy happens faster as we move forward. The fourth and final vector of the delivery strategy for FY19 is continue to invest in the future. We think we are in a great position, and we should not get bogged down by short-term challenges, which I think we have put largely behind us, and we need to continue to invest for the future. And there are 3 clear differentiators for the bank as we see them today. 1 is our digital capability, 2 is our analytics capability, and 3 is our subsidiaries. As the world changes, we believe that the digital and the analytics capability will become materially important from a competitive advantage perspective, because the world becomes more data-driven, and your ability to leverage that data gets impacted by that capability. And as I mentioned, our subsidiaries, which were very tiny a few years ago, have done well, and I think today they're becoming a more material part of the group. With that, I really want to hand it over to Jairam to talk through the numbers, and we'll happy to come back during Q&A.
Thank you, Shikha. Good evening, friends. As Shikha has painted a great picture of what FY19 looks like for Axis Bank and what our forward-looking strategy is, I want to take a couple of minutes of your time to talk about Q4, what the numbers were, what were the key focus areas there. Clearly, the bank significantly accelerated NPA recognition in this quarter. Slippages were at 16,500 crores, most of which, about 13,900 crores, came from corporate lending. This recognition was mostly from the BB and below book, and particularly from the power sector. Power was the dominant sector from where we saw slippages, and it contributed upwards of 40% of all the NPA formation in this quarter. The new guidelines from the regulator on resolution of stressed assets did drive some of the recognition, particularly in the restructured book. Our gross and net NPA ratios ended the quarter at 677 and 3.4%. We believe, as Shikha was mentioning before, that the NPA recognition phase of this cycle is nearly complete with what we have done in this quarter. Most of the corporate slippages, of course, 90% plus, came from the disclosed BB and below book, because of which the BB and below book reduced by 44% in this quarter, from 16,700 odd crores to about 8,900 crores. It now forms 1.8% of customer assets, which is roughly 1/4 of what it was at its peak, which is 7.3%. Our watch list is closed with this quarter. Watch list outstandings at the end of the quarter was 428 crores, and we have now merged it with the business as usual pool, and the watch list will no longer exist. The bank has continued to maintain a fairly healthy provision coverage ratio at 65%. From a capital adequacy perspective, we have adequate capital. At this point, having done the bulk of the provisions and put it behind us, we still have the common equity tier 1 at 11.68%, very significantly above regulatory minimums, and hence we believe that given our history of using about 50 to 55 basis points of capital a year to fund about 20% of loan growth, we believe that we have at least 2 years, if not more, of growth that we can fund with the level of capital that we currently have. From a financial performance perspective, as you saw, we delivered a loss in this quarter of 2,189 crores, which gets us to a full year profit of about 275 crores, 276 crores. NII was flat YOY, driven in large part by the large recognition into NPA and the interest reversals associated with that. Loan growth continued to be very strong, 18%. Retail continued to do very well. SME has been doing well as well. But as again Shikha was mentioning before, we are seeing good traction in the corporate lending segment as well, and we saw corporate lending business grow at 12% in this quarter. All this was supported by strong growth on the deposit side as well. CASA on a cumulative daily average basis also grew by 18% YOY, and we continue to maintain fairly high levels of CASA ratio. We continue to be among the top players in the digital space, whether it is mobile transactions, whether it is UPI or any of the others. And finally, before I close, the one other thing I want to talk about is in terms of what our outlook is and what some of the numbers are that we are thinking we would attempt to hit in the coming year. We believe net NPA formation, given all the recognition that we have done now, net NPA formation or new NPA formation in the next financial year will be significantly lower than what we saw in this year. Credit costs, we continue to look at a second half normalization, and we will see how the resolution environment works, and if it really truly does pick up, if IBC phase 1 does have the kind of resolutions that we are looking for, we will see whether we should look at that timing. But as of now, we continue to guide for a second half normalization of credit costs. We continue to expect loan growth in the high teens, supported by a high teens growth in the deposit side as well. Margins, we are expecting margins to be stable to financial year 18, So we think the compression trajectory of margins that it has been going through over the last 2.5 years is now pretty much done, and we should be looking at a stable to upward trajectory on margins. And as you look at the medium term, we are targeting an ROE of upwards of 18%. And as we look at FY19, you should see us take a fairly big step forward towards that goal. In conclusion, what I'd say is that at this point, the bank has the capital, the appetite, as well as the balance sheet strength to pursue some strong growth in financial year 19. Thank you very much for listening, and we are open to your questions.
We've been hearing for some time that the NPA cycle has reached the point where all recognition is complete. But we've been surprised quarter after quarter, and this quarter especially, we saw 16,000 upwards of slippages. What really would you attribute to it? You mentioned that bulk of them have come from the power sector. How much of it is on account of the new revised NPA framework that RBI released in Feb? If you could just give some more color on what really we should expect realistically going forward as far as NPAs are concerned.
No, I fully understand the question that, is the resolution cycle really over? I just want to mention two things here. One is, yes, the recent regulatory guideline on it forces us to recognize things where there were dispensations earlier. So it's a different regime, and we have fully incorporated that regime in the results for this quarter. And if you look at the outcomes as a result of it, Jairam mentioned the BB portfolio is now 1/4 of what it was at its peak. And as far as BB is concerned, we've been disclosing that consistently over years, and more than 80% of our slippage comes from BB. So this quarter is 90%, but on an average, or more than 80% comes from the BB portfolio. So that should give you some comfort that there are numbers to back the confidence that I think the recognition cycle is today more or less done with. It's not that we won't have slippages, but I think the elevated level of slippages should certainly start to normalize. If we look at our SMA2 numbers as well, ever since CRILC reporting started, it's at the lowest ever. So if we look at the data around the rating composition of the book or the early delinquency numbers, they all give us the confidence that, yes, I think the recognition cycle is behind. To your question on how much of this comes from the regulatory change and how much is otherwise, for the corporate slippage, Jairam...
You're not disclosing the membership.
You're not disclosing. But a material part comes from there.
13,938 is the total slippages from the corporate sector. We are at this point not disclosing what specific amount within that came because of the new regulatory guideline.
But it's a very material number.
13,900 crores of slippages or new NPA formation came from the corporate sector.
Is this your first ever net loss since it became listed in 1998?
Yes.
Jairam, just trying to understand this 1,300 crore or tax write-back now. Going to include that loss, and the loss would look much larger. Going ahead now, obviously you're predicting that or expecting that in the second half of this year your numbers are going to look better. But come next quarter or the couple of quarters, what exactly is the reasonable expectation to have on the profitability side, not just margins or loan growth?
Sure. See, firstly, the tax write-back is a real thing. If you when you pay the taxes, it goes out of your PAT. So if you're overpaid on taxes, the write-back is real. So it has to be taken into account when you look at the overall profitability of the firm. I mentioned in my comments that our medium-term goal is return on equity upwards of 18%, and we should get there. And as you look forward into financial year 19, you should see us making a very significant step in that direction. So I don't think we worry about the underlying sort of profit trajectory. The operating engine has been working just fine, as you continue to see the core operating profits continue to do well. So we are fairly confident that as
the recognition cycle abates, the profit will show up from operating profit to net profit as well.
Going back to the NPA recognition cycle question again, I wanted to understand a lot of resolutions now are going to be based on how IBC pans out, and what we've seen so far, all cases are mild and litigations, haircuts are fairly large. Only 1 out of the 12 cases has been resolved from the festival so far. Does it really inspire confidence in this current form that this will lead
So as far as the resolution process is concerned, I really think that to come with such a material change in legislation and implement it as quickly as India has done, it's truly remarkable. And what you look at as delay, I think in some senses is testing the regulation and fine-tuning it, so that from here onwards you have more certainty in how some of this will get interpreted by the court and implemented. So frankly, I wouldn't worry too much about the fact that there is a couple of months delay in some of these cases, because they're all on the right path, and we are seeing a path to resolution in each of these. As far as the haircuts are concerned, I think we've been consistent saying that in the IBC 1 and 2 list put together, we expect that there could be a 60 to 65% haircut. And so if we look at the numbers that have come up, that's not surprising in the context of what we've been guiding, and that's what we've planned on the basis of.
And as a bank, on all the IBC accounts, we are meaningfully above that percentage in terms of provision cover that we have. So we feel that we are adequately provided in terms of the haircuts. Yes, yes.
You know, I know it's you've been conservative and taking some of the recognition in this quarter, preserving from the Fed circular, but do you think there are some sectors like power possibly still under-recognized? There could be some surprises, so or any other sector you believe could have spring some surprises?
So power was the last of the large sectors which have caused stress. As we know, infrastructure, roads, infrastructure-related sectors and power have been a large part of the NPA that has come through in the last several quarters. Power has been the last of these sectors. A very material part of NPA recognition this quarter is coming from power. So there could still be some slippage going forwards, but I think a large part of the power sector slippage has happened in this quarter itself.
How much of standard power assets are still left on the book?
The power portfolio now is just about 9,000 crores.
Okay. And in that, are there
And the overall NPA ratio within the power sector is now upwards of 40%.
Okay. 9,000 crores is the portfolio?
Yes.
Outstanding. So the expectation is that 40% will remain at 40% and not go.
Well, the iron and steel sector, which so far has been the most troubled sector from a risk standpoint, pretty much peaked out around 45% of stress, and now power is pretty much caught up. On our portfolio, power recognition is caught up with where iron and steel is. So I mean, it's not like no other power NPAs will happen, but in our portfolio, we've seen the bulk.
A very large part of it has gone through.
No, we're not sharing guidance on a quarterly basis, no.
What are the surprises which you're factoring in when you say that the normalization in credit costs will happen in the second half? Like what are, like, if not the number, but what can be the potential?
Yeah, two main things. Firstly, the impact of IBC and how the resolution cycle actually pans out, how much write-backs you get, how fast does the process go, etc. So all that stuff. The second is the ongoing impact on credit culture. Shikha mentioned the change in credit culture that is driven by the Feb 12 circular and the IBC environment. You need to just give it a little bit of time, we believe, to play out and see how clients actually respond in this environment, and how much is the stable state sort of slippages that you see. If the loan market is going to be treated somewhat similarly as the bond market in terms of one-day default being kind of the norm, you have to just wait a little bit and see what impact does it have on clients and on slippage numbers. So we are cautious about watching that before we make any assertive statements.
Could you share the SMA2 number?
We're not sharing an exact number, but we'll tell you that our SMA pool right now is less than 0.5% of our loans. Less than 0.5%. Less than 50 basis points of loans.
Talking about this one-day default norm, and that's something that you've already been implementing or at least starting to implement. It's something that the RBI Deputy Governor also mentioned that a lot of large companies have been, faltering on that front. What do you think is the reason? Is it even reasonable to expect Indian corporates to repay exactly on due date, or is there extension sort of built in whenever you give a loan?
I'd just like to repeat what the Deputy Governor said. If a bond payment is due, it happens on that day. So hopefully the credit culture will change when the loan payment is due, it happens on that day.
But do you think lack of infrastructure financing under 525, etc., matching the cash flow, etc., lack of those
I think what the RBI said was 525, which was not implemented. But when you do a fresh infrastructure loan, I don't think there's any restriction on how you structure the repayment of that loan. So you could still go that route if that's something which you believe is right for the project.
Sorry, I've been told we need to sign off. So, okay, so we'll take the last question. Yeah.
So, you spoke about the corporate segment where you're seeing ample growth opportunities. Could you specify where exactly these opportunities are coming in from? And you spoke about retail and SME as well. Many people feel that SME is a soft spot. How is it at Axis Bank? And as far as retail is concerned, if you could speak a bit about that, are you seeing signs of strength in that segment as of now, especially in the housing loan part?
No, I think we're pretty happy with the credit experience we've seen on the retail and SME segment. It's continued to be a reasonably benign environment. As far as growth is concerned, retail has been a source of growth for the entire industry. It's certainly been a big source of growth as far as we are concerned. SME, which used to be soft growth in the past, has actually done pretty well last year, where we've done close to 20%, 19% growth. So growth's come back in SME. Corporate growth, again, used to be weak, but for two reasons. One, the consolidation of demand coming from IBC, and two, just some consolidation of demand across the sector. We are seeing corporate growth come back as well. So some of it investment related to IBC, I think, will also come through.
Also, SEBI was supposed to get a report on the WhatsApp, the internal flow that you had. I think 7th Feb was when you had to submit the report. Yeah. Have you heard from SEBI in the past 2 weeks or so since you submitted the report?
No, we haven't. We've submitted it.
Thank you, everyone.
Thank you. The leadership change that you discussed earlier, can we expect something along those lines?
Sorry, what's that?
A potential merger for Axis?
No, I think I mentioned that I think Axis is a great institution. We've built a lot of capabilities. We believe we're very well positioned for growth. So we're happy to pursue that growth. If there's anything else that happens, I'm sure the board will evaluate it appropriately.
Thank you, everyone.
Thank you.
Okay, so that's the much awaited Axis numbers and the press conference. The press conference didn't add much beyond what the press release had already said, and that is that almost all the slippages, which is fairly large at 16,000 odd crores, has come from the existing BB and lower rated corporates, and therefore it has come from the known devils. There has been no bad loans outside. Even now, at 6.7%, Axis compares very favorably with other corporate lending banks, be it SBI, ICICI, PNB, BOB. All these comparable banks have higher NPAs than Axis has. Also, it's extremely well capitalized. So the fact that a bulk is recognized and the management is boldly coming out and as in one voice saying that the recognition cycle is over and the resolution cycle will continue or will kick off should inspire confidence. My sense is that the bad news is in the price. The bad news is known. Once it is known, it will be in the price. And therefore, perhaps there is reason for Axis Bank not to fall much tomorrow. What's your sense, Abhishek?
Yes, as you mentioned, Lata, largely factored in terms of pricing. Two great things that they have spoken is that they are now expecting the trajectory of lower NIMs to bottom out. So from here onwards, either the NIM, that is the net interest margin, will remain stable or improve.
Higher.
And they are sufficiently capitalized. So that augurs well for, growth coming ahead. They can grow at 20% plus for many years in this capital level itself. And the overall SMA pool, which, is the main focus, worrisome factor because of RBI's new rules, that forms less than 0.5% of the book. So largely, if you look at the picture, the overall stress is actually factored in. Front-ended with NPS and now you have residual. So you have already seen a price correction, about 8-10% over the last 2 to 4 weeks. So that must have factored in the fact that they have not paid advance tax. So largely the result might have got factored in. We need to see how it reacts tomorrow.
Okay. Yeah, I would think it's not a pleasant set having a loss, but then this was largely expected and it's come because they have provided for a large slippage number that they have declared. So it looks like the market will take this in its stride and move ahead. But we will see that tomorrow. Thank you very much for watching this special presentation